$5,000. Borrowed from a bank. Every month, the bill arrived. Every month, it was paid. Not once missed. But 15 years passed. The debt hadn't ended, paying faithfully every month, yet the balance barely moved. There was a reason. There is a customer the bank wants, someone who pays, but never fully pays it off. The person who satisfies both conditions at once. That is the bank's perfect customer. We are taught that paying off debt quickly is simply the right thing to do. But the bank's ideal customer is not the one who eliminates debt. It's the one who keeps debt in a manageable state, for as long as possible. This single distinction is why minimum payments exist, and why credit scores are designed the way they are. Look at FDIC data on U.S. banks. Almost 2/3 of bank revenue comes from interest. Not investment returns, not fees, interest. The moment principal comes back, that interest stops. Does the bank want its principal back? To answer this, you have to look inside a bank's earnings report. J.P. Morgan Chase recorded an 18% return on equity in 2024. The core of that was consumer lending, especially credit cards. The interest-income ratio of credit card specialty banks, 10.16% of total assets, more than 3 times the average commercial bank. The return of principal is not revenue. It is the end of revenue. This is the true blueprint of the bank's profit model. Then why does the bank lend even to those who can't repay? This question is the key to understanding this structure. 3 gears sustain this structure. The first is the interest revenue model. The second is the design of minimum payments. The third is the securitization of debt. Each doesn't operate independently. They mesh and turn together. The first gear. The bank doesn't make money by lending and getting principal back. It makes money from the interest that flows while the principal is being returned. This difference is decisive. Suppose you borrow $5,000 and pay only the minimum each month. The current average U.S. credit card interest rate, 25.2%. The first month's minimum payment, about $150. Of that, $45 goes toward principal. The remaining $105 is the bank's interest income. Next month, the same. The balance drops a little, so the bill drops a little. So the amount actually going to principal also shrinks. With every faithful payment, 70 to 80% is heading straight to interest. Run the official calculator, and the result is this. $5,000 principal, minimum payments only, total repaid, $8,109. You pay 62% of principal as interest alone. Full repayment, 15 to 20 years. Start after college graduation, and you're still paying when middle age arrives. This is where the first trap ends. The debt is being paid, but in reality, it barely shrinks. The second gear. For this trap to work, people must choose the minimum payment. Why do they choose it? In 2009, Professor Neil Stewart of Warwick Business School gave the answer. Stewart handed out mock credit card statements to experiment participants. One group saw the statement with the minimum payment line intact. The other group had that line removed. The result was clear. When the minimum payment disappeared, the amounts people paid rose dramatically. A large-scale field experiment in the UK in 2023, 48,000 actual credit card holders. When the minimum payment was hidden from the screen, the proportion of full payers jumped by nearly 50%. This is the anchoring effect. The number printed on the statement becomes a psychological anchor. That number is perceived as the appropriate amount recommended by the institution. About 48% of UK credit card holders actually held that misperception. The bank knows this. The minimum payment is not a safety net. It is a psychological device that slows repayment, a legally designed cognitive trap. In 2009, U.S. law required statements to also show a recommended amount to pay off in 3 years. How effective was it? Accounts that chose the new recommended amount, less than 1% of the total. Once the minimum payment had already dropped its anchor, a friendly warning meant nothing. The core is simple. This system doesn't want default. It wants long-term residency. But this structure has one more locking mechanism: the credit score system. If minimum payments slow repayment speed, credit scores guide you to stay inside the debt ecosystem entirely. The second largest factor determining your credit score is credit utilization, the ratio of current balance to total credit limit. Experts recommend below 30%. But what about 0%? According to official sources, a utilization rate of 0% is actually worse for your score than 1%. Using no card at all lowers your score. The reason is simple. What the algorithm measures is not financial soundness. It's how well you maintain debt. The average utilization rate of those with the highest scores, 7%, not 0%. There always needs to be a little debt, because the very way to protect your score is to stay inside debt. The problem isn't that debt exists. The problem is that it's designed to linger and to keep being maintained. The third gear, debt securitization. This mechanism is the core of why banks lend even to those who can't repay. The bank executes a loan and doesn't hold that receivable. It bundles, packages, sells mortgage-backed securities, asset-backed securities. Debt becomes a financial product. It disappears from the bank's books and transfers to an investor's portfolio. In this structure, the bank's incentive shifts. There's no reason to lend only to those who can repay, because the receivable is going to be sold anyway. The more you lend, the more product you have to sell. Whether credit card or mortgage, the structure is the same. The moment debt becomes a tradable product beyond a repayment relationship, the bank's interest moves from collection to distribution. 2008 was the case that showed how far that logic could run amok. Collateralized debt obligations issued in the US in 2006, $50 billion in a single year. Of the debt bundles created in 2007, an average 36% was filled with subprime mortgages. The debt of people with no ability to repay was packaged into top-rated financial products. When housing prices began to fall, the chain collapse began. Physical losses from actual mortgage defaults, under $350 billion, but passing through the amplification device of derivatives, the total losses sustained by the global financial system, IMF estimate, $3.4 trillion. It grew roughly tenfold. A $1 loss in the underlying asset appeared as dozens of dollars of value collapse in the derivatives market. A structure in which principal recovery is not the goal, a structure in which debt is sold as a product. This was the result when those two designs meshed. Thus, debt has become not merely a matter between banks and individuals, but the very skeleton sustaining the entire modern capitalist system. And so, a thought experiment becomes possible. If every person on Earth paid off their credit card debt tomorrow morning, what would happen? In 2024, US consumers paid $160 billion in credit card interest. Total global debt, $348 trillion, more than 3 times the combined global GDP. If all debt vanishes, banks fail. If banks fail, corporations can't raise capital. If corporations stop, employment collapses. The modern economy does not function without debt. Let go of the goose and the golden eggs. Stop, but kill the goose, and the entire farm collapses. This is the paradox of this system. Debt is not a personal problem. It is the fuel of the system. And yet, there are countries that burn the same fuel differently. Look at Denmark. The absolute ceiling on annual interest for credit card loans, 35%. More important, the philosophy of lending assessment is different. It must verify the borrower's actual repayment capacity, not the bank's loss risk. Required by law. As a result, by end 2024, the average effective interest rate on all Danish bank loans, 3.8% to 4.8%. Finland's average credit card interest rate, 10.4%. The ceiling, the benchmark rate plus 15 percentage points, and under no circumstances may exceed 20%. Borrow the same money and you pay less than half the interest of the US. Compare with the US. US average credit card rate, 25.2%. Retail co-branded cards, 31.3%. No federal-level interest rate ceiling exists. Since a 1978 Supreme Court ruling, banks relocated to states with no rate regulation and applied unlimited high interest rates nationwide. The same $5,000 of debt. In Finland, you pay far less interest. In the US, on minimum payments only, you pay 62% of principal as interest. This is not a difference in individual choices. This is a difference in regulatory design. Look at Japan, and there is yet another model. Japan's household debt to GDP ratio, 61%. Lower than the US, 68%. Credit card revolving rates are low, and lump sum payment culture is strong. Banks diversified revenues through fees and overseas investment instead of high-interest consumer loans. These are evidence that different designs are possible. That the system was built this way is not a law of nature. It is the result of choices. Then, faced with this structure, what can we do? At the individual level and at the societal level. At the institutional level, as the Nordic model shows, enforcing a legal interest rate ceiling forces banks to tighten screening instead of covering losses with high rates. In Denmark, a mandatory 48-hour cooling-off period exists before a loan is executed. In Denmark and Sweden, financial education is not elective, it's part of public school curriculum. If schools teach that minimum payments act as anchors, the anchoring effect weakens. At the personal level, technique is needed to work against the structure, not moral conviction, strategy. When you have multiple debts, cut the highest interest rate first, the so-called avalanche method. The faster you reduce principal, the less time interest has to flow. You are using the system's own logic in reverse. In 2016, a scandal broke at Wells Fargo. Ghost accounts were opened without customer consent. 1.5 million deposit accounts, 565,000 credit cards. Why did it happen? Management's goal? An average of 8 financial products per customer. Cross-sell achievement rates were the metric proving revenue-generating capability to investors. Documents were forged to fill that data. Final settlement? $3 billion. Wells Fargo is not an exceptional crime. It is an extreme case showing how far this system can be distorted. It shows what happens on the ground when pushing consumers into debt structures is the revenue model. Let's return to the first question. Why doesn't the bank want you to pay off your debt? Not because the bank is evil. This is not a critique of the structure. The bank is operating exactly as designed. As long as interest flows, there is revenue. When principal returns, revenue stops. This simple incentive explains everything. The minimum payment was designed as a safety net, but functions as an anchor. The credit score is a proof of soundness, but a reward system for maintaining debt. Debt is securitized and sold, so the bank cares more about distribution than recovery. 3 gears and 1 locking mechanism, turning together, interlocked. Finally, the goose story. The golden egg-laying goose is inside the fence. The goose appears to roam freely, but the size of the fence was decided by someone else. The moment the goose realizes the fence exists, the story changes. It can't go outside the fence, but it can know what the fence looks like. The moment you understand that boundary, the way you move changes. The things I now take for granted, minimum payments, credit scores, loan structures, are they really designed for me or designed for someone else's profit? That one question is the beginning.